it's like, hey, I put this money and oh my goodness, congratulations, it's done really well. But the outcome is suddenly a big chunk of your net worth is in one stock, and you don't want to, you want to sell it to diversify, but if you sell it, you pay a big capital gains tax. And then the question is, well, is there a way to sell this stock and not pay a huge capital gains tax?
Welcome to Retirement Today. I'm your co-host, Jonathan Berglund, and with me, as always, is Michael Reese, certified financial planning professional for over 25 years. And we're having a great day, aren't we, Mike?
Oh, my gosh. You know we are.
We are. We're having a good time, having some laughs here in the studio before we get started. You know it's going to be good.
Yep, that's right. Hey, welcome, everybody, to the show tonight. And by the way, we got I've got two great topics.
Yeah.
Right? So this is what we're going to talk about tonight. The first thing we're going to talk about is, what do you do when you find yourself in, well, kind of the fortunate position of having, maybe you work for a company, you've been buying their stock, or you were given stock options or something, and suddenly you find yourself having a ton of your net worth in one company stock. And you're sitting there, you're like, oh my goodness, I know I've got it. I got to do something. I can't just sit here and I can't go into retirement having all my net worth in one company. I mean, what if the company goes under? There's huge risks there. And so that's a problem. We're going to talk about how do you transition from that to a more diversified portfolio, but to do so in a very tax efficient way, right? So that's topic number one.
Right.
Topic number two. This is a question we've been getting all the time. And that question is, hey, Mike, I got all this money sitting in cash.
Mm-hmm.
And the bank is paying me how much, Jonathan?
Point nothing.
Yeah, a lot of point nothing. So what options are out there where I can get a decent return, get something on the money that I keep at the bank?
Yeah.
We're going to talk about that too. So those are our two big topics.
Those are great. Those are pain points for a lot of people.
You like it?
I do.
All right. So this all came up because about a week ago, I had a very nice couple come to the office. They were listening to the radio show like you are right now, and they had called in to get their Retire Right report, which we provide for free for people who save some money, saved at least $200,000. Anyway, they called in and said, hey, we want this report because in their situation, they were both late 50s, like I think 58, 59, something like that.
Yeah.
And he worked for Apple. And over the years, he had bought Apple stock.
Mm-hmm.
And here was their situation. He says, Mike, I feel both good and bad. I'm like, well, what do you mean? And he said, well, I feel good because I have $2 million saved for retirement.
Ooh.
You feel good about that?
Yeah, absolutely.
Yeah, so you feel that's great, right? I'm like, sounds pretty good so far.
Yeah. What's the bad part?
What's the bad part? That's what I said. So what's the bad news? He goes, well, here's the thing. 1.5 million of it is in Apple stock that I've been buying in the employee stock purchase program over the years. And that's all outside of his IRA, by the way.
Wow.
Right?
Yeah.
And his cost basis was something like $300,000. So he's got 80% gains. He's like, here's my problem. I think he's 59 and his wife is 58. And he says, hey, here's my problem. I'm going to want to retire over the next few years, but I know it's not a good idea to retire. Yeah, I've got 2 million, but if 1.5 of it is in one company stock, because I know that's not good. Now, I feel blessed that the stock has performed so well.
Right.
But I need some help because if I asked him, I said, so what do you think is a reasonable amount of stock to hold in Apple?
Yeah.
He said, honestly, if I have $2 million total and maybe I own 500,000 in Apple stock, that's cool. But I don't think I should have more than that. And in fact, he goes, that's why I'm here. I'm like hoping you'll tell me.
Yeah.
Right.
Yes. Right.
And in any event, his problem was, he goes, how do I sell this $1 million of Apple stock that is 80% gain and not get hammered on
Yeah,
taxes.
the IRS is just rubbing their hands together, getting excited over there.
They might even be drooling.
Yes.
Like, I've got my dogs. Every time I go to feed my dogs, they get real excited and they start drooling. That's like the IRS right here, right?
Yeah, absolutely.
So if you did the math, like if you wanted to sell $1 million of stock, but it's 800,000 of capital gains, that's going to hit him at about 23.4 in today's world, 23.4%.
Yeah.
I don't have my calculator in front of me, but I'm going to tell you that's close to $200,000 that he has to give the IRS if he were to do it all at once, right? And if he were to do it over time, it's still going to be close to that number.
Mm-hmm.
So, and his position was, I don't want to give the IRS $200,000.
Fair enough.
Now, I don't know about you, Jonathan. Would you be excited about writing a check to the IRS for $200,000?
No, that's painful. That is painful.
Yes, I don't think so. Right? Yeah. What was that TV show? It was Home Improvement, where Tim would say something, and his partner, I think Al, would say, "I don't think so, Tim." Yeah, same thing here. I don't want to write a check to the IRS for $200,000. I mean, I get it. So his question for me was, are there any tools, are there any strategies that we can employ to, and maybe not all at once, but how do we transition that $1 million in Apple stock into a more diversified approach?
Mm-hmm.
He goes, look, I'm not going to retire for 3-4 years. Is there a way to do it over that time, or over at least some period of time, where I don't get hammered on taxes? And hey, the good news is, because we are big at tax planning here, right? The company I work with, my company is called Centennial Advisors, and we're really good at tax planning. We do a lot of tax planning. And I was able to tell him, I say, hey, the good news for you is there are certainly ways to help fix that problem.
Yeah.
And so what I want to do tonight is I want to talk about that a little bit. What do? You're like, maybe you're like this guy. You've got a lot of money in some individual company. Heck, I had another guy. He worked at a company called Logitech,
mm-hmm.
right? He was given a lot of stock options. And when he left there, he left with basically, he had like over $1 million in Logitech stock, and his cost basis was almost zero.
Oof.
I mean, it's crazy.
Good and bad again.
Yeah,
right?
but same situation.
Exactly, yeah.
When you find yourself in a situation where you're like, oh my goodness, good news. I have a lot of money in one. I've done really well with one company stock,
mm-hmm.
and it's outside of an IRA. Because if it's inside of an IRA, you can sell it with no tax consequence. It's super easy.
Right.
But it's outside of an IRA. I've got, you have a bunch of money in one company. Maybe it's IBM. I have that come up.
Yeah. That's common.
Apple. We see that. Google. What else have we seen? I saw Logitech. I saw, Texas Instruments was another one
there
that we came across.
Yep.
You have all this, and it's like, hey, I put this money in, and oh my goodness, congratulations, it's done really well. But the outcome is suddenly a big chunk of your net worth is in one stock, and you don't want to. You want to sell it to diversify, but if you sell it, you pay a big capital gains tax. And then the question is, well, is there a way to sell this stock and not pay a huge capital gains tax?
Eliminate the pain point as much as possible, right?
Yeah, I mean, you're going to pay some tax probably, right? Actually, there are ways to avoid the tax altogether, but they're pretty convoluted. You probably don't want to go to that extent.
Right.
And here's the thing. What we're going to talk about, the solutions that we're going to talk about here, they really apply when you have you need to really have over 500,000 in that one stock.
Okay.
So if you've got, hey, I've got 200,000 in one stock, is there a way to sell it and avoid major capital gains? The answer is no, probably not. And well, there probably is, but it's not worth the money or the expense. You pay more in the,
process,
in the process than you would in taxes. And the reality is, if you've got 200,000 of gain somewhere, what's a tax bill? Maybe 20, 30,000, which still stinks, but it's not 200,000 or 300,000.
Yeah.
Right?
A little more manageable. Yeah.
So if you have over 500,000 in a stock and you're saying, man, the stock's done well, I love it, but I don't want to be going into retirement with this huge percentage of my net worth in one company.
Mm-hmm.
That's not a great idea. Last week, I was talking about, I had a couple, very nice couple, came into the office. They had saved $2 million for retirement. He's 59, she's 58. $2 million, they're doing great.
Yeah, great job.
The problem and he knew, he's like, I know I've got a problem here. The problem is that of his $2 million, 1.5 million of it was all in Apple stock.
Mm-hmm.
And the cost basis was about $300,000. So this was after tax money. It was like an employee stock purchase plan for the most part. And then every time he'd get more money, he'd buy more Apple stock because it was doing so well. And yeah, good news, it did really well.
Mm-hmm.
Bad news, now he wants to say, hey, I want to sell a big chunk of it and get more diversified, to limit risk and manage risk, which is perfectly sensible.
Saying all the right things, yeah.
He goes, the problem I have is I'm going to owe a boatload of tax.
Yep.
And so how do I avoid that? Legally. Not,
of course.
I mean, it's not like
always. Yeah.
Everything we do is legal, of course. And so one of the solutions that we've been using a lot for people in that situation is we take that portfolio, we take that Apple stock,
mm-hmm.
right? And we hold it at, a custodian like maybe Fidelity or TD Ameritrade. We say, let's put the stock there. And then we calculate what's called an annual tax budget. We say, let's identify what a reasonable amount is of capital gains tax, that we could pay each year to be palatable.
Okay.
Right?
Okay.
Something like that. And then let's say the number is, hey, I'm willing to pay. Let's say the number is, hey, I my budget says I can handle, I don't know, $20,000 or $30,000 a year of tax.
Sure.
Right. So I say, okay, year number one, sell enough and we'll pay the $20,000, $30,000 of tax. Right. Maybe the first year we do a little bigger chunk, which is common. Maybe we'll pay $50,000, but we'll sell enough stock, $50,000 is tax. We'll take it out of the stock account. You don't have to come up with the money out of your pocket. Right.
Mm-hmm. Right.
So we create that first year and once that money's sold or the stock is sold, it goes to cash. And then what we do is we build a more diversified individual stock portfolio. So let's do some math here. He's got $1.5 million.
Yep.
Right. Let's imagine the first year we say, let's just take 200,000 of it.
Okay.
And we're going to sell it to cash.
All right.
That's going to create a tax bill of maybe $25,000.
Roughly.
Right. So we got 200,000 in cash. What are we going to do? 25,000 goes off to pay the IRS. That leaves 175. We take the 175 left over, we invest it in a more diversified portfolio of individual stocks. But then what we do is we start tax harvesting that 175.
Okay.
So what that means is, what does that mean? What it means is, let's say you buy like 50 stocks. So it's more diversified
mm-hmm.
than one stock. You buy 50. Jonathan, over the course of the next 3 to 6 months, are all 50 of those stocks going to go up?
Definitely not. No.
Are they all going to go down? Probably not. Probably some will go up, some will go down. So here's what we do. Take the losers and sell them, capturing a loss.
Okay.
Right?
Got it.
You take the money from the losers, reinvest in new stocks. But what did we do? We just captured a loss.
Yeah.
What can we now do? We can sell more of the Apple stock at, whatever the loss is, sell Apple stock at a gain. They offset each other. Boom. Tax-free tax-free Apple sales. So now we've got more money moving into the, diversified portfolio, right? 3 to 6 months go by, find more losses, sell those, cash out some of the Apple again, right? And just kind of keep that process going.
So on and so forth. Yeah, that makes sense.
So the idea is, will there still now, by the way, by doing this, where we might initially say, man, it's going to take like 10 years to
mm-hmm.
cash out all this stock with Apple, it speeds the process up. We might be able to get get that Apple stock down to where we want it to be position wise in maybe, I don't know, 4 or 5 years. Right. And instead of paying all the tax, like $200,000 in tax, like we were talking about before the break, maybe it's only like 100. Maybe we cut the tax in half. Maybe we do even more than that, maybe a little less than that. But the point is, you pay a lot less than the $200,000. So it's a neat little way to legally manage a portfolio, do some tax harvesting to capture losses, and at the same time, it allows us to move these concentrated stock positions into diversified portfolios tax efficiently and more quickly, right? Thank goodness for technology to help us, handle it all, right?
Yes, yeah.
But here's my question. Who's helping you do this stuff? If you're sitting there and you're sitting like this couple that came to my office. I'm talking to them about this. They're like, why doesn't anybody tell us this?
Yeah.
Right? Why doesn't anybody tell us about this? Well, because most financial firms, they don't pay attention to taxes, do they?
No, that's true. We have a lot of fun here in segment number 3 here.
Yes, this is my favorite part of the show because this is where I get to be king for a day. Oh my gosh.
And do we have fun? Yes.
I love this. All right. So every week I like to do this segment because just to get a little humor in here.
Yeah.
And
lighten it up.
Yeah, I could talk about financial stuff forever, but we got to throw a little curveball in there. And so this is a segment where I imagine if I were king for a day,
right?
What are 2 laws that I might, create?
Yep.
One might be a law on the financial side, and another would be a law on the, just general life side.
Rest of the world, yeah.
And the idea is to, there's so many things out there that just annoy me. So I thought, what the heck? Let's create a segment where I can create laws to fix the problems that our world has in my mind.
Yeah. Yes.
In my mind.
Naturally. Yeah.
All right. So here's number 1.
All right.
So we'll do the financial one first. It is tax season.
Indeed.
All right. Well,
planning.
When I say tax season, tax planning for most of our clients, but if you extend your taxes,
it's still tax season.
It's still tax season.
Yeah.
And this morning when I came to the office, we extend taxes. This is crazy. So like I have my QuickBooks all completed, for the year by like the first week of January. So you would imagine that our CPA could file our business taxes like right away. Well, the problem is he can't because there's a number of documents that you have to wait to get, 1099s and what are called K1s and all these documents that the IRS creates in their complex world. Well, we finally have them. So we're essentially today I came in with all this huge stack of documents and we're scanning them in so we can scan them off to our CPA, right? And I understand that when you're running a business that things can get a little complicated, and especially in my case when you're running maybe 2 or 3 businesses.
Right.
But it got me to thinking about just, your average person, right? And your average person is maybe they've got W-2 income,
right?
They get their employment income. Maybe they've got a couple of kids or maybe they're retired. They've got, nobody really itemizes these days.
Not with the standard deductions.
I mean, given where that's at,
right.
So you would think that taxes, here's what I think. I think taxes should be simple.
Ideally, yes.
So I'm talking to one of my buddies who happens to live in Australia.
Okay.
And for whatever reason, I was, bemoaning the complexity of our tax code. And his comment is like, man, that sounds crazy. Here in Australia, right? It's like a flat number. It's like you put in your income. There's a flat percentage you pay on that income. And by the way, I don't know if he's correct about this. I'm just relating what he said to me. And, you just put in, it's like a postcard. You just drop in your income, drop in the tax rate. Like, I think he said it was 15% or something. And then whatever it is, it is.
Yeah.
And off it goes to, the exchequer, whatever they call it there. Right. And I'm thinking to myself, you know what? Why can't we have that?
Yeah, it's simple. I've heard it is simple at other places too, like UK,
Yeah.
for example.
Why
Similar. Yeah.
why can't we just have a simple tax? Like, here's how much I made.
Right.
Forget about deductions. No deductions. Right? It's just income. And by the way, this is where, like, how do you account for capital gains?
Right.
And all that kind of stuff. Here's what I'm going to say. I think all income should be taxed at the exact same rate in my little kingly world here.
Income is income.
Income is income. I don't care where it comes from. So income, you get this much income, and then it's taxed at a flat rate. But let's make the rate, like, if with no deductions, we can make like 15%, right? It'd be lower than current everything rate, basically,
Yeah.
right? And then just boom, that's what Washington, D.C. gets, right? And here's the thing. No withholding allowed.
Oh.
And the reasons I want people actually having to write a check to the government every year so that they know what they're really giving the IRS.
I like that, actually. Yeah. Yeah.
It's not easier for people to do, but
No.
it's like pretty soon people get sick and tired. They're like, why the heck am I sending so much money to the IRS? These guys are bozos.
What am I getting? Yeah.
You know, the government's a bunch of bozos. So anyway, so I think simple flat tax rate, income at that tax rate, no deductions, and you got to write a check to the IRS. How do we feel about that one?
I like it. I can't find too many faults in that one.
Although I'm sure people say, well, what if I don't have enough money and I didn't save and all that? I understand.
Yeah. All that.
I understand this is never going to happen in the real world. It's just me and my little, reality. But for that, I'm going to go with it. So our new law, simple tax rate, write a check. And at this point, we can go ahead and rule that it is law. Okay, there we go.
There it is.
All right, my non-financial ruling, law
I know you're excited about this.
is related.
Okay.
It's related. I mentioned a few minutes ago, I think, that a lot of people in Washington, D.C. are a bunch of bozos.
Yes, you always have kind things to say about them.
Kind things like they are worse than pond scum. So here's my idea. What if, and I saw some commercial the other day where it was a guy was lying and his nose grew like Pinocchio. I don't know who it was for or anything. I just remember seeing it.
Yeah.
And of course, in my mind, I'm thinking, what if we could create some kind of cool law that would, every time a politician lied,
Oh, boy.
anytime a politician's representative in Washington lies,
Okay.
anytime someone in the news lies,
Ooh.
right? The media and whatever side of the media you listen to, anytime they lie or misrepresent something, and here's the best part, either knowingly or not.
Oh, okay. Okay.
Because you got to have a little fun with this.
Okay.
What the heck? I thought I was telling the truth.
Yeah.
Their nose grows.
Gross.
Right in front of us.
Just like Pinocchio.
Just like Pinocchio. And so, like, if you're a politician in office for like 50 years, like some of these people are, it's like they wouldn't be able to
You can't
walk
hold your head
because
up, yeah.
their nose is so dang long, right? And the bigger the lie/misrepresentation, boom, the bigger it goes. Can you imagine, how these politicians, they pull in people to what do you call it? They go under oath in front of the Congress, like in front of a committee. Testify.
Yes.
They testify in front of a committee. Where these politicians, they don't care. They never listen to what this person's talking about. All they want to do is do a soundbite for
Get their soundbite out there in the media.
their personal view.
Yeah.
90% of those time, those sound bites are misrepresenting things in some way, shape, or form, right?
Mm-hmm.
So here they are on TV making that sound bite, and boom, their noses just start growing.
Cut them off quickly.
That change? or like these news anchors, right, reporting whatever is in front of them, and boom, their nose grows because it's not true. Wouldn't that change how things are reported? Wouldn't that change how our politicians behave? I think so.
I think so. Yeah.
I just don't know if we have the technology to make this happen yet.
That's some pretty intense medical technology there, yeah.
Wouldn't it be cool, though?
It would be neat. It would be neat.
We need like a little lie detector / misrepresentation buzzers. Oh, and there'd be a buzzer. You also have to have a buzzer, like as soon as, hey, we're going to do this, or I can't believe this, or, every time they make these statements, like, hey, under this person, unemployment rose by 55% or something, and like, bing, bing, bing,
Yeah.
alarms go off, and the nose starts growing.
Right.
Wouldn't that be cool?
Yeah, the fact checker.
I think that should be a law.
Yeah.
I think that should be a law. So here we go. I'm going to go with this. Our new law with politicians and news people and anybody who represents politicians, news people, the news media, those people, because the news media, a lot of those people are much better than politicians, right? They're just talking heads. Again, there are obviously exceptions to this, right?
Of course.
There are obviously high quality people in the political arena, high quality people in the news media. There are. I mean, please do not. I'm not trying to paint.
Don't write us any letters.
Broad of a brush here. But we know how a lot of them are, right? We all know that. So the rule is, a new law is that when caught lying, alarm bells go off and their nose grows. Right? How do you feel about that?
I love it.
I'm just visualizing this.
I know,
That'd be
me
so
too.
fun. All righty. So with that, we will rule it. It is law. Okay, gang, we've had a little bit of fun.
That was fun. That was good.
We came across this the other day,
Mm-hmm.
and I remember I saw it, and my eyes just popped.
Yeah.
And if you remember, I said, hey, Jonathan, send me an email to remind me to talk about
It
this.
was immediately. We couldn't do it right then and there, but we had to get on it later. Yeah.
Yes, it's something I said, Jonathan, send me an email so I don't forget about this. So historically, I remember when I was a kid.
Right.
I was a kid in the 70s and the 80s, and, interest rates then were really high.
Yeah.
And whenever I walked into a bank when I was, a teenager, there would be a sign. Like you walk in the bank and here's a sign. These days, nobody walks in a bank, right? We all do it online. But
Rarely, yeah.
back in those days, there was a sign. And the sign was titled CD rates, right? So CD stands for Certificate of Deposit. And the rates, it would show, hey, for the next, if you put money in a CD for 3 months, we will pay you 2% on that money.
Mm-hmm.
If you do 6 months, it might be 2.5%, or you do it a year, maybe it's like 3%, and so on. The longer the CD, the higher the interest rate. And my mother lived on these things, right?
Yeah.
My mother, my sainted mother, she's 85 and still kicking. She would go to the bank, and periodically she would just put money in these CDs. In fact, she would ladder them a lot of times.
Sure. Yeah.
Where she would say, hey, I've got, 5,000 in this one that matures in a year, and maybe 5,000 one that matures in 2 years, and maybe another 5,000 matures in 3 years. And so every year as it would mature, she just get another 3-year to get the higher rate. And so every year she'd replace it with one would mature, get another 3-year, and so on.
Right.
Right. And in those days, it made a lot of good sense for money that you had in cash, because they were paying decent rates. Yet when, especially ever since 2008, when the rates went down about nothing,
Right.
their CDs have not made sense for, I can't tell you when.
It's almost a joke. Yeah.
Yeah. They've been so low, and they're still not that great. Right.
No, not really.
So what popped our eyes open? Well, the other day, Jonathan and I were sitting in some meeting. We're kind of doing some research on something, and we came across this. We're like, holy smokes. Today, as we're doing this recording, so by the way, as we're talking here, right, this is what's available now.
Yeah.
Now, I don't know how long this is going to be available for. I don't know if they're going to take it away. I don't know. I'm sure they will take it away at some point. But right now, today, this instant, you can get from an A-rated insurance company, you can get something called a 2-year MIGA.
MIGA.
Do you know what MIGA stands for?
Multi-year guaranteed annuity.
You're so smart.
How about that?
He's so smart. Multi-year guaranteed annuity. So what is a multi-year guaranteed annuity? In English, it's a CD at an insurance company.
Yeah.
That's basically all it is. Yep. Right? It's like instead of getting a CD at a bank, it's a CD at an insurance company. Right now, for 2 years, you can get guaranteed 3.5% per year. And at the end of 2 years, so that's 7% total. At the end of 2 years, boom, you walk away, you're done. So it's like the old-fashioned CD. 3.5%.
That's awesome.
For 2 years.
Yeah.
It's incredible. Now, I know what you're thinking. Mike, there's got to be a
catch.
There's got to be a catch.
What's wrong with this?
Yeah. What is up with this? There is a catch. The catch is, and as I did further research, it requires a minimum deposit.
Okay.
Any guesses as to what that minimum deposit might be? $10,000?
That's my guess.
Okay. $80,000.
Really? Okay.
Yeah.
Okay.
So if you've got a pretty good chunk, it works really well if you've got a pretty good chunk at the bank. It's $80,000 minimum. But if you put in $80,000, you're guaranteed 3.5, 3.5% year one, 3.5% year two, and then boom, you're done. You get your money. Go do something else. Right? Now, I know what you're thinking. Like, man, 80,000. Ah, man.
Yeah.
I don't have 80,000. Okay. Well, guess what? The same company. What if you have maybe 20,000?
Okay. There we go.
Between 20,000 and 80,000, same 2-year account, they're paying 3.3.
Oh, you're basically there. Yeah.
So not much different.
No.
So here's the thing. Today, this is basically guaranteed for 2 years. That's it, just 2 years. If you got cash at the bank, $20,000 minimum, you can get 3.3% from an A-rated carrier. And if you have 80,000 and above, it's 3.5. So 3.3, 3.5, 20,000, 80,000 are the thresholds. Now, when you're starting to get to those numbers for such a short term, I mean, my gosh, suddenly this idea of CDs, it's not a CD, but it's basically a CD at an insurance company. Suddenly they're starting to make some pretty decent sense, right?
Yeah. The rates popped up. That's what we were surprised by, right?
Yeah. Now, we did notice that 5-year rates are over 4%.
Yeah.
Right. You can, if you want, and they're much smaller, like you can do like 10,000 minimum or something like that.
Yeah.
For 5 years, you can get north of 4%. And some people would say, hey, if I've got cash that I'd love to get over 4% for the next 5 years locked in. Hey, if that's you, then we can be helpful there as well. I was just really surprised by the 2-year rate.
Yeah. For such a short time period to get that rate, it's nice.
So here's the thing. Let's imagine you're sitting out there and you're like, holy cow, I need more information. I might be interested in this. We can help you with that. All you got to do is give us a call. The number is 512-886-5850. And it is after hours. So that means when you call, you're going to get an answering service, right? And they'll set up a time where you talk to Jonathan. You call and say, hey, Jonathan, I want to know more about these, these MIGAs, they're called. MYGA, multi-year guaranteed annuity. I want to know more about these MIGAs. These are insured accounts. Your principal's insured and protected, and you're guaranteed a certain rate. So 2 years, it's either 3.3 or 3.5%. 3.3 requires at least 20,000. 3.5 requires 80. And then if you want to do more like 4 or 5 years, we have those available as well, over 4% with a lot lower required deposit. So if you want to learn more, you just call us. So Jonathan, what's that number again?
That's right. It's real simple. 512-886-5850. Again, the number, reach out to us, 512-886-5850. 5850.
Yeah, I think that this is going to blow the phones up a little bit.
Yeah.
I know.
I'm waiting for it.
Here's the reality. I mean, think about there's how many, couple million people in the Austin area.
Now, yeah, it's crazy.
I'm sure, hundreds of thousands are listening to KLBJ right now, right?
Yeah.
And you're probably out there like, holy cow, that would be a very interesting opportunity. And we just help people kind of first come, first serve.
That's right.
So we'll do our best to get, we're probably going to get like dozens and dozens of calls, maybe more. And so if you're out there, you want to call us now. Make sure, first come, first serve. Let's get you on the calendar so at least you can learn more, see if this is for you. I don't hardly ever do this on the radio show, but it's an opportunity that I felt would best serve the listening audience.
Yeah, that's right.
I mean, where are you going to get 3.5% a year for 2 years? Guaranteed, insured account where it's protected, right? Guaranteed. No, there's no moving parts here, right? It's like a CD at a bank, 3.5, or that's for 80,000 or more. If you have 20,000 for 2 years, it's 3.3 and 3.3, and then 2 years you're done.
Do something else.
It's super easy.
Yeah.
Now, what if they have smaller amounts? Like, what if you only have $10,000? And you can maybe there are 4-year, 5-year options, and they're earning over 4%.
Yeah, a little bit more. Yeah.
In fact, I think the 5 years getting close to 4.5.
Right.
So again, these are the rates as we're having this conversation, right?
Yep.
We don't know what they're going to be.
Who knows?
That's what's available now. I don't know how long they will be available for. So I know I can get it now. My best guess is we've got an insurance company or two out there that are saying, hey, we have an opportunity to allocate some funds. We need to collect some dollars. And as soon as we collect a certain amount in these accounts, we're done. We see that happen quite a bit. And so that's why I'm telling you, this is not something you want to kind of, mess around with.
Sit on, yeah.
Yeah, you don't sit on it. So again, last time, let's get that number out there. If you're interested, call the number, set up a time, talk to Jonathan.
Yep.
Let's see if we can help you out. What's that number, Jonathan?
Reach out to us at 512-886-5850. Again, the number is 512-886-5850.
All right, make sure you call now. Let's get you those great rates. All right, gang, that's our show this week. Hope you enjoyed it. We will talk to you again next week.